in many ways, what's happening is that private credit is getting much more diverse. So for the longest time, private credit essentially just meant direct lending to corporates, to private equity-owned corporates. And that's been a big business, and that's been a growing business. That business is getting a little bit crowded. But what we're seeing is a diversification of private credit away from corporate borrowing into a whole variety of other asset classes, what's being called asset-based finance. So this would be taking on residential mortgages, taking on credit card receivables, consumer loans, taking on aviation finance, things like that. Things that banks used to do, or almost all of the credit would come from banks. Now, as banks, especially since the regional bank failures in 2023, as banks are optimizing their balance sheet, they're looking for partners to sell some of these loans to, and asset managers like PIMCO are there to take on those loans and package them into strategies for clients.
So to simply put, it's safer because you've got collaterals, and is it safer because you're working with banks? Is that the way to understand it?
It can be safer. It's safer if it's done correctly. That's right.
Asset-based.
Because it's asset-based. That's right. There's this collateral, this asset underneath what you are lending against. And so take aviation finance, for instance. You're making a loan against a plane. Now, of course, it depends to whom are you leasing the plane and the quality of that airline. But of course, ultimately you have that collateral. Ultimately, you can repossess the plane. So many of these assets are more like a investment grade type of profile than what you see in corporate direct lending, which is much more of a low, high yield, single B type of profile. These things aren't rated by the agencies, but if you think about the credit quality, it is a higher credit quality.
I was hearing about how some of these private credit deals, I would imagine it's more about corporate finance and structured finance deals, that they are actually relaxing their covenants because they're chasing after these deals and they're having a little bit of FOMO. So going a little bit easier on EBITDA requirements on companies, is that what you're actually seeing on the ground?
Yeah, what you're seeing is more on price. That's where people are more competing, less on really relaxing on covenants. Covenants in direct lending remain reasonably tight. Okay. So that is something that has not been significantly modified yet. What you're seeing more, though, is people competing on price. So a deal that used to come at 550 basis points over the risk-free rate would now be 400 basis points over the risk-free rate, or 425. And those are at the very, very tight levels. But you have seen those spreads start to come in. But the reality is spreads are low everywhere. Spreads are low in the regular way corporate bond market as well. And so that's what really is happening, is that direct lending is just reflecting the reality of tight spreads elsewhere in the market.
I'm seeing a lot of this trend of trying to get retail cohorts involvement in private market. Private credit is no exception.
Yeah.
Is that dangerous to do that?
Well, it's not dangerous if it's done right. And almost all managers are using structures that limit the amount of liquidity that's available to those investors on a quarterly basis. So on a quarterly basis, you can take some out, but usually it's about 5% of the overall fund can be redeemed in a given quarter. And most of these funds, particularly those diversified funds in asset-based finance, have a lot of cash that comes in from pay downs on the underlying loans. And so you're a little balanced that way between the amount of money that can come out of the structure and the cash that comes into the structure. So generally speaking, the industry has designed this in a way that is balanced with respect to asset and liability match.
Before I get to the whole big R word that everyone is talking about, just because everyone is so nervous about April 2nd, more tariffs coming, how is the deal flow at the moment? Do you, for one of the hottest, one of the biggest conviction calls, for example, asset-based lending, do you see healthy deal flows at the moment?
We are seeing the most robust deal flow we have ever seen, and PIMCO has been in this business for 17 years to varying degrees. We are seeing banks, especially now spreading into Europe, coming out with multi-billion euro, multi-billion sterling pools of loans as banks are really assessing what's the optimal balance sheet that they have, what's the optimal deployment of their capital structure. And so we're seeing prime consumer receivables, we're seeing residential mortgages come out, we're seeing student loans in the U.S., we're seeing solar installation loans in the U.S., auto loans as well. So it really is this whole gamut of, but again, the theme is collateralized, backed by these assets. So, and it's not a story of distress, it's actually a story of health, of banks really assessing what is their optimal capital structure, then working with large asset managers who can take down these multi-billion pools of loans.
That's your deal flow, but what is the credit market telling you about potential recession? Everyone is worried about economic slowdown.
Yeah. So far, there have been some stresses in the credit market over the last 6 weeks or so on the back of the equity volatility that's there. But so far, spreads are marginally higher from very, very low levels, and that's really all that's happened.
What is marginally higher?
Yeah, it's credit spreads in high yield are 20, 30, 40 basis points higher, generically speaking, which kind of brings them nowhere close to being on average for the last 20 years. So they're still quite low. So it really is more of a repricing than a signal that a recession is coming. If you were to have another 50, 75 basis points of widening in high yield, then it would start to tell you that something more serious than just a repricing is coming.